We are covering alpha, beta, and standard deviation for the Series 65 exam. These concepts are crucial for understanding risk and return, and the exam will test your ability to differentiate them and understand their relationships. Let's start with the broadest measure of risk, standard deviation. Standard deviation measures the total risk of an investment, which includes both systematic and unsystematic risk. Think of it as the dispersion of a security's returns around its average. For an exam question, imagine two mutual funds, Fund A and Fund B, both with an average annual return of 10%. Fund A has a standard deviation of 20%, while Fund B's is 8%. The Series 65 will expect you to know that Fund A is the riskier investment because its returns are more volatile and spread out. A higher standard deviation means a wider range of potential outcomes and therefore greater total risk. Next is beta, which is a much narrower measure of risk. Beta measures only systematic risk, which is the risk inherent to the entire market that cannot be diversified away. The market as a whole, often represented by the S&P 500, has a beta of 1.0. An exam question might state that a stock has a beta of 1.5. This means the stock is expected to be 50% more volatile than the market. If the market goes up 10%, the stock is expected to go up 15%. Conversely, if the market drops 10%, the stock is expected to fall 15%. A stock with a beta less than 1.0 is less volatile than the market. The key exam takeaway is that standard deviation is total risk, while beta is only market risk. Now let's discuss alpha. Alpha is a measure of performance. It represents the excess return an investment has generated compared to its expected return, given its level of risk measured by beta. For example, based on a fund's beta of 1.2, its expected return was 14% for the year. However, the fund actually returned 17%. The fund's alpha is positive 3%. This positive alpha suggests the portfolio manager outperformed and added value. A negative alpha would indicate underperformance. The Series 65 will test alpha as the risk-adjusted return that shows a manager's skill. Finally, we must connect these concepts with R-squared. R-squared is a statistical measure that represents the percentage of a fund's or security's movements that can be explained by movements in its benchmark index. It ranges from 0 to 100. An R-squared of 90 means that 90% of the fund's price movements are attributable to movements in the benchmark. This is the most common exam trap. For alpha and beta to be meaningful and reliable indicators, the R-squared must be high. If a question presents a fund with a high alpha but a low R-squared, say 40, it's a trick. The low R-squared indicates the chosen benchmark is a poor fit for the portfolio, making the alpha and beta statistics essentially useless for evaluating the manager's performance. A mnemonic to remember these is A alpha is the manager's A game, beta is for bouncing with the benchmark, and standard deviation is the scary dispersion of all returns. The exam will try to confuse you by asking which measure accounts for unsystematic risk. Remember that only standard deviation, the measure of total risk, includes it. Beta only measures systematic risk, which is non-diversifiable. For free practice questions, AI-powered explanations, and more exam prep tools, visit openexamprep.com. That's openexamprep, all one word, .com.